Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 219 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, Nick Whitaker, our Director of Research and Trading, is back on the show, sitting in for Matt. So as always, Nick, good to have you.
Good to be back. It's been a while.
It has. Yeah, back in the office for the first time full time this week after working from home for a couple weeks to help Kenzie with the baby, and yeah, it feels good to get back on a normal routine. So
yes,
it was very
as
exciting.
normal as it can be with a couple week.
Yeah,
old, right?
Exactly. Yeah, she's 4 weeks. She's gonna be 4 weeks old today at 5:03. So getting closer and closer to a month under our belt. So yeah, it's gone by slow and quick, if that makes sense. The days when you're in the thick of it, it's just like, oh my gosh, she's been crying for an hour and a half. But at the same time, it's like, man, how has she already been here for a month?
Yeah, that's what they say. As you get older, the days are long, the years go fast, something like that.
Yeah, exactly. So as always, we will take the first few minutes to talk about the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and it is as of September 20th. So S&P 500 is down 2.3% for the month of September and up 14.7% for the year. The Dow Jones Industrial Average down 0.8% for the month and up 3.9% for the year. The NASDAQ Composite Index down 4% for the month, but up 28.7% still for the year. The Russell 2000 Small Cap Index down 4.6% for the month and only up 3.2% for the year. And the Vanguard All World ex United States ETF down 1.3% for the month and up 6.3% for the year. 3-month Treasury rate sitting at 5.56%, the 2-year Treasury rate at 5.12%, and the 10-year Treasury rate at 4.35%. So we had a little bit of a bump up in yields, obviously yesterday, Nick, with the Federal Reserve and their press conference. They actually left benchmark interest rates unchanged, and the current range right now is 5.25% to 5.5%. And at the same time, they were signaling that borrowing costs will likely stay higher for longer after potentially one more rate hike this year, which is interesting. So a few tidbits from yesterday's press conference. They said that they're, quote, prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down substantially toward our objective, which is 2%. After raising rates rapidly last year, now we're fairly close, we think, to where we need to go, Powell said. Yields on 2-year Treasury U.S. government bonds rose after the decision, and the S&P 5 index, as many could probably imagine, erased earlier gains and sold off about 1% for the day. Lastly, officials also continued to project inflation would fall below 3% at some point next year, and they see it returning to 2% in 2026, which might be a shock to some people, Nick. 'Cause everyone probably feels like I do when I read that. It's like, whoa, 2026 is more than 2 years away.
Yeah, it seems like a long ways away. Yeah.
So I know you're going to have some data here in a little bit for probabilities with rate hikes through the rest of the year and the beginning of next year. So we will leave it there.
Yeah, we'll dig into that a little bit more for listeners later with some research pieces.
Right. First thing I had, Nick, was a article from Adam Turnquist, and he is a CMT at LPL. The article was titled "Breaking Down the Breakout in Oil." So he starts off by saying tightening supply has been a significant driver of crude oil's rally over the last 3 months. Saudi Arabia, the de facto leader of the Organization of the Petroleum Exporting Countries, otherwise known as OPEC, and now more commonly referred to as OPEC Plus, which includes Russia and other non-OPEC oil exporting countries. They all have voluntarily extended their production cuts of 1 million barrels per day until the end of the year. This means the Saudis will hold output at around 9 million barrels per day, marking the lowest production quota in several years. Russia also voluntarily extended its export reduction of 300,000 barrels per day over the same period. On the demand side of the equation, China continues to import more oil. In August, they imported 52.8 million tons of crude oil, or 12.5 million barrels per day, marking a 21% increase compared to July. In the US, implied oil demand reached multi-year highs. So, Nick, Adam and his team looked at the performance of oil after it advanced for 9 consecutive days, which just happened, over the last week or two. And what they found was of the 7 other periods that registered a 9-day winning streak in oil since 1983, and this is WTI, forward returns over the next 12 months have been impressive as WTI gained an average of almost 16.5% and finished higher in all 7 periods. So Jen will throw this chart up on the YouTube video and in our show notes for people, but it shows crude oil and the performance after a 9-day win streak over a 1 week period, 1 month, 3 months, 6 months, and 12 months. And a year later, each and every time oil was trading higher. So again, small sample set. So a little caution there, but with this data combined with what the Fed just decided to do in some of their comments, Nick, it kind of makes sense that, hey, they don't think we're totally at the end of this inflationary period, and energy makes up a significant amount of inflation prices. So this is something to definitely keep an eye on. Could this time be different? Absolutely. But this looks like a pretty strong trend to me. But again, small sample size that people just need to be careful with.
Yeah, it's always interesting to read about the oil space and everything that's going on there for listeners, which I'm sure most of you are aware of. But the price of oil is predominantly driven by supply and demand, simple economics, right? And so that's really what has sparked this little 9-day run here, and a lot of it just gets down to the oil producers, whether it be Saudi, Russia, OPEC plus, even and the US. They make more money when the price of oil is higher. So
Right.
by curbing the supply and saying, hey, let's pump a little bit less, then they can help drive the price up, and they make a little bit more money. So it's kind of that fine line for the producers of, you don't want the price to go so high that you curb demand, but at the same time you don't want to, keep the prices low. And so it's just finding that balance. And so that's one of the reasons for the volatility in the energy space. And you add in the cyclical nature of the global economic cycle, and that's where you can kind of get all these swings and why we have some of this back and forth. But we're in an upswing right now, so.
Yeah, two final comments on that. One, so I think everyone should be prepared for a little bit higher prices at the pump when they're filling up their cars. And number two, I think this is a really good example, Nick, of kind of the market sniffing this 9-day streak out, or this breakout, if you will, in oil prices. The past couple months leading up to this, energy stocks had been doing pretty well. Over the summer months. They had a weak start to the year, but over the past 3-ish months, they've done pretty well. And then here you have more production cuts. Oil is breaking out. So that's just a really good example for listeners or people new to investing of how the market, prices in these things way in advance, right?
Yep, absolutely.
So just wanted to throw that out there.
Yeah, that's a great point. I was actually looking at market reversion yesterday, and if you look at the market beginning of the year until, let's call it end of July. I used a few different dates, but end of July, you see a lot of strength in your tech, your consumer services, some consumer discretionary. But then since the end of July, you've actually seen a little bit more reversion towards the value sector with energy outperforming. Energy is the best performer since July. So to
Yeah,
your point.
very interesting. Yeah. Nick, the second thing I had was a quote from Lucien Hooper, who is a former securities analyst who was pretty well respected in our industry and in technical analysis specifically. So her quote, which I found was really funny, is whenever you find the key to the market, they change the locks. And what I think my interpretation of this from Lucene is, everyone is in the search for that black box of a strategy to implement in the market. And to my knowledge, I think to 99.9% of everybody else's knowledge in our industry, there is no one single strategy that has worked from the market's inception till now that hasn't gone through significant drawdown, significant volatility, significant underperformance. So if people are trying to chase, beating the market every single year, year in and year out, there's just not a strategy out there that exists, or else we wouldn't have the returns that we do in the market each and every year. So, some years are going to have value outperform growth. Some years are going to have international outperform domestic, and vice versa. Same scenario with value and growth. Sometimes large caps, small caps, and mid caps are going to have different performances over different time horizons and different years. So, I think in probably the early 1970s, 1980s, value was really in vogue, right? It was like buy the lowest PE ratio stocks.
Yeah.
And fast forward to really like 2015 to 2020, you had all of these really high PE stocks were the ones that were outperforming the market. So, people go back and read books. For example, Benjamin Graham, he was a value investor, and they think, oh my gosh, you have to invest just like Benjamin Graham. He's super smart. His returns were great. But you also have to take into consideration that was a different time period. So you always just have to keep your mind open to adjusting strategies and tweaking portfolios based upon the times that you're in. Because there is no black box strategy that is going to make you do significantly more than all the other investors in the world and the markets. So I just thought that this was pretty funny, because we hear it a lot that people think it's easy to beat the index, and obviously in hindsight it is, but
Yeah.
I think Lucene had a really good piece of, or tidbit of, knowledge for everybody.
Yeah, I'll tell you what, in hindsight, I bet I could beat it every time.
Yeah, exactly. It's easy looking back. It's like, oh, I should have added more international. I should have cut more international,
Yeah,
especially over the past decade. Everyone's like, oh yeah, the place was to be in US stocks, but you
yeah.
don't know that until you're
It's
past it, right?
yeah, yeah, and there will always be stories of black box hedge funds that are outperforming and for XYZ reasons. And just know that often it's short term, it's temporary outperformance. They go through bouts of volatility and extreme underperformance and extreme outperformance and all of that. A great little article or research for listeners to read into on this topic on black box, and these guys thought they had the perfect strategy and it was just gangbusters, and then it blew up, is Google long-term capital management,
Oh
and
yeah.
read about that. And that's kind of what we're talking about here, where these guys were these genius mathematicians that had beat the market and broke the market, and then it just went south really fast and they had to get a bailout. It's a whole thing. But read up on that. That'd be an interesting thing if you'd like to read more about something
Yeah,
in that arena.
did you read that book, Nick, about that?
I didn't read a book. I learned about this a long time ago.
I'm
Like
pulling up.
probably 10 years ago, something
I
like
keep
that.
like a ticking list of books I read. I think it's not Barbarians at the Gate. That was about a different company. Where are we here?
I've
It
read
was a
about
really
it, and
good
then
book.
I watched a documentary about it. Like I said, a long time ago, but it's definitely if you're interested in reading about some of those black box hedge funds and what can go wrong,
Oh God, yeah.
that's a good one to read.
It's called When Genius Failed. It's by Robert
Oh,
Lowenstein.
okay, yeah.
Yeah, actually, I have it here in my office if you ever want to take a peek at that. So,
Yeah.
yeah, really, really good story that they've had the smartest people in the world working for them, and the strategy blew up, right? So, last thing I had, Nick, was a chart of the VIX on a seasonal basis, and this was from Callum Thomas from Top Down Charts. So Jenna will throw this up for our YouTube viewers, but if you're looking at this chart, Nick, again, for new listeners, the VIX is just a volatility gauge of the markets, specifically the S&P 500, right? So when the VIX is moving higher or at high levels relative to its history, you could expect more market weakness. People are getting more defensive, buying more put options, which is bearish. Won't get into that too much today, but as you look at this chart, Nick, what do you see? I mean, from January pretty much until July, August, volatility tends to trend down for the first half of the year. But then from about the middle of July, late July until early October, mid October, volatility tends to increase. So again, this mixed with the week 2 week period that we're in for the S&P 500, the weakest 2 weeks out of the whole entire year right now, this combined with the VIX tending to increase, volatility tending to increase, would not surprise me again if we get more weakness before we enter Q4. Again, do I think it's going to be a strong Q4? Yes, I do. We've talked about that before, but right now, if we look at history and use it as our guide, it shouldn't be surprising to us to see increased levels of volatility or minor corrections in the market. So I don't want people to freak out if we get to the end of this 2 week period, volatility has increased, markets have come in another 5 or 10%. That would be normal in my opinion. So just wanted to throw that out there as well.
Yeah, it's a great point and a great chart. And some of my pieces of research are going to assist in making sense of some of that. And why I agree. I think we'll likely see some more volatility in Q3 and over the next couple months. And with that often comes little corrections, swings back and forth. You'll see the market move a little bit more day over day than maybe it has in the past couple months. So be listeners, be prepared for that for the next quarter, three months or so. So the first piece of research I have is it was actually, I saw it on Twitter. It's a post from Bloomberg Markets, and it just said a big week for central banking. And there's a chart that we'll throw up this week, or there's a chart that we'll throw up that shows all the different central bank rate decisions this week across the world. And the quote that they put up was, a 36-hour rush of global monetary decisions may set the tone for the rest of the year as the world adjusts to a U.S. push to keep interest rates high. Advanced economy central banks, accounting for 6 of the 10 most traded currencies, may draw particular focus as global policymakers adapt to the theme U.S. officials set out at Jackson Hole in August, that rates are likely going to stay higher for longer. So the rates obviously unchanged yesterday, but they did signal that we're going to be higher for longer. We don't see inflation coming. We see inflation coming down around 2% in 2026. So there's certainly some I don't want to call it confusion, but there's people who disagree with that. I would say there's people on both sides of the coin, where some people think inflation is going to come in way quicker. And then some people are forecasting rate cuts as early as next year, and some people think that we won't cut until late 2024. So we'll see what happens, but just another big kind of moment in the markets right now with all these central bank hikes. You just showed that chart on volatility where we are seasonality. So I think a lot of this is just setting up for a little bit more back and forth. But I don't know
Right.
if you have
Yeah.
anything to add there.
Yeah, and the only thing I have to add is that I was looking this morning, the ECB or the European Central Bank also held rates steady where they were following the Fed yesterday. So it matters a lot more now, I think, than it did historically in the past with just globalization in general, what other central banks are doing, just because of how interconnected all of these countries are, right? Yeah, I think inflation is still actually significantly higher in Europe than it is here in the U.S. So interesting that they held rates steady as well.
Yep. And my next piece of research is just some more comments on rates, and this is a tweet from I'm going to struggle with this name, Gunjan Banerjee.
That's how I would have said it.
All right. Sorry, Gunjan, if I pronounced that incorrectly. The quote is the following. It's actually a snippet from Goldman Sachs research, and it says Goldman on interest rate cuts in 2024. We see cuts as optional because our analysis suggests that most of the impact of higher interest rates is behind us, meaning that the economy does not need cuts to avoid recession. Still, if inflation continues to move towards the target as we expect, we suspect that most Fed officials will think it is appropriate to slowly lower the funds rate from a level that we see as quite restrictive. So just in summary, Goldman thinks the Fed is done hiking and that they will not have to cut rates until 2024, sometime in the end of the first quarter, unless something drastically changes with the growth outcome. If GDP comes in 20% under expectations, then they would acknowledge that their forecasts are wrong.
Yeah, yeah,
Um,
exactly. Yeah, it's interesting because if you look, I know you included some target
yeah.
rate probabilities, and if you look at the end of Q1 for March of next year, still a 50% chance that the Fed is still at 5.25 to 5.5, and even a 35% chance that we're going to be slightly higher at 5.5% to 5.75%. So, interesting to see Goldman's opinion on that and kind of where they see things going.
Yeah, so I put some notes here, just a bunch of charts, and we can throw up a couple for listeners. And I just wanted to talk through these just to give listeners an understanding of where the market is from a rate perspective, because I think it's important to acknowledge that 50% of the market is in the same spot, which means 50% of the market is thinking otherwise, right?
Hmm.
So 73% of the market thinks that at the November meeting, there'll be no change. So the market majority, everyone's pretty much on the same page for November. But once we get into projections for December and beyond, it's about 50% is on the same page, and the other 50% is dispersed. So in December, we have 50% thinking, 54%, we're going to be precise, thinking that the rates are going to stay unchanged, at 50% unchanged in January, 50% unchanged in March. And then in March is the first time we see 7% of the market forecasting a decrease in rates. So the reason I bring this up, and I thought it was a timely research piece, is just to kind of bring all this together and combined with your chart, combined with what we talked about, energy moving higher, expect some volatility. Anytime you have the market Anytime the market doesn't have a really clear picture as to what direction we're going with the Fed, expect a little bit of sector rotation, a little bit in and out, some choppy trades. That's the market that we're going to be in, most likely throughout the end of the year. We'll get some more data, obviously, throughout the next couple of months, and then the Fed will come back and speak again in November. So that will be an interesting time to see if they can kind of clear that picture up. If the economic data is still looking really good, you could get a little bit of a bump, but we'll see. So.
Yeah, it's interesting. I saw a tweet by Charlie Bilello the other day, Nick, and he said and this was on September 19th, so the day before yesterday, which was the day before the Fed meeting. And he said that the market is pricing in a 99% probability of a pause heading into tomorrow's FOMC meeting, Federal Open Market Committee meeting. In every meeting since 2009, the Fed has done exactly what the market was expecting it to do, not a single surprise. So I know these are target rate probabilities, but it's been spot on for the majority every single time of what the Fed has done. And I'm sure there's going to be a time where they surprise the market. But that's why we do put a little more weight into this is, there haven't really been much or many surprises since 2000 or any surprises, I guess, since 2009.
Yeah, and these probabilities will shift drastically from now until
Mm-hmm.
the end of the year, and they shift drastically, sometimes day over day, depending on the news that comes out or Fed speak, et cetera, et cetera. But just interesting to point out that that's where we are right now. Is the market's about 50-50. We think we're gonna 50% thinks we're gonna kind of hang in this range and not make any changes until March. The other 50% is unsure, either hiking more or taking one down. So we'll see what comes in the future with economic data and see how that tweaks things. The last piece of research I have for listeners is a Bloomberg article on bearish strategists raising their forecasts. I saw this one over the weekend, and I read it, and I found it interesting, and just wanted to kind of point out a couple things. So the title of the article is Wall Street Comes to Grips with How Wrong It's Been in 2023. And I'm going to read some things, and I'll kind of talk through the article. It's not a super long article, but it's a little lengthier, and I won't read the whole thing to you guys. But stock market strategists who were largely wrong about this year's rally are finally starting to come out and face their mistakes, raising year-end targets for the S&P 500. So Society General, Piper Sandler, PNB Paribas, Bank of America, Goldman Sachs, Citigroup have all raised their forecasts. There's a whole slew across the street that have raised their forecasts. So, the most bearish of those were, I think, Piper and BNP, who had at the beginning of the year, they were forecasting the S&P finishing at 3225 and 3400 respectively. So that just shows you how low the range was. Society General, for example, they were their original call was 3,800, and last week they raised their year-end target to 4,750. So pretty significant difference there.
Yeah, that's way lower than, from where we are right now down to like 3,400 is more than 20% from where we are lower today. And I think it's just, now that people are talking about this and they're revising their price targets upward, Nick, it's funny that at the same time we're going through a market pullback right now. So it's like they can't seem to win this year, and in my opinion every year. That's why me and Matt have talked about this all the time on the podcast is targets, year-end targets are just stupid.
Yeah, I mean, and this article is not setting out to bash these guys. It's incredibly hard to do what these guys do, and they have to do it, right? That's their job. Pick a number, right? They have to do it. The main point of this article is just to kind of show that, hey, the bears have been forced to raise their targets enough to basically admit that they were at least wrong on the timing, right? So another notable bear I should say is Morgan Stanley's Mike Wilson. He conceded in July that he was pessimistic for too long, though he still sees U.S. stocks falling more than 10% before the year is out. So, even more than 10% before the year is out, that's still a pretty drastic swing. So, the article acknowledges that, obviously these guys are raising their forecast, but it doesn't necessarily mean they're bulls yet. It says strategists broadly forecast the market downturn in 2024, even as signs mount that the U.S. economy may avoid a recession. The rate of inflation has cooled overall, retail sales remain strong, and the Federal Reserve is expected to hold interest rates steady this week, which it did. For investors with money on the line, the gloom on Wall Street creates a dilemma. It's a reminder that the Fed's effort to tame inflation still threatened the economy. At the same time, stocks overcame the same threats in 2023, and now, with corporate America's improving profit outlook and the Fed itself seeing no signs of a recession, some market watchers are concluding that the bears are going to be wrong again. And that little synopsis was one of the main reasons I wanted to talk about this. Is that whole dilemma side of things. If you were to jump on ship with the Bears at the beginning of 2023, then that would have been unfortunate, right?
Mm-hmm.
So it's always good. We've talked about this all the time. Stick with your long-term strategy. Talk to your advisors. Understand what's going on, but don't panic. Take appropriate action if you think a change is needed, but it's all about the long-term strategy. There's always going to be these times in the market, and there's people on both sides of the coin. We talked about the 50% with where we think the Fed's going to go. We talked about the Fed talking about inflation coming down in 2026. There are people who think it's going to come down way sooner than that, as early as the end of 2024. So there's still a lot to be digested. So we'll see.
Yeah, a lot of interest rate talk, obviously this week, Nick, and markets continue to be pretty weak here at the open. S&P 500's down about 0.8% so far today. So obviously, market not quite liking what the Fed had to say, but again, we have to remember we are in this seasonal period where we expect market weakness. So.
Yeah, and I think the Fed does that to some degree, where they might historically they give the market what the market wants, i.e. whatever rate change is expected. In this case, no change. But they'll also come back and they typically have some language that kind of spooks the market a little bit. So one of the things that stuck out to me from Powell was him talking about a soft landing, and that he doesn't see a soft landing. Let me find that. I had it somewhere.
Yeah, I remember you had it in here that he didn't necessarily say that the goal was a soft landing.
Right. So whenever when you hear that, that's the market doesn't want to hear that, right?
Right.
So there's always going to be little things like that, and I don't know if you've ever seen those where the research pieces where they'll take the entire Fed release and then they'll go through and analyze what words are different from the previous one, like down to like a little phrase of like, oh, this tiny 4-word sentence was redacted, and the market will analyze that. I mean, they really, really focus a lot on the language, and I mean, just saying something about, might not be a soft landing, the market's like, whoa. So
Right.
it doesn't shock me that we're down a little bit today. I'd expect some weakness following that.
Yeah.
Following some of his comments.
For sure.
So.
Well, we're bumping up against time, Nick, so I'm going to skip over the financial planning topic of the week. I will talk about that next week. It's about saving for a house, given the current market environment with interest rates that we're in. I think this is a timely discussion to have, just because you're a homeowner, Nick, I'm a homeowner, but you know when you go to save for a house, people are just like, oh, I need just the amount for the down payment, number one, and number two, I just have to be able to pay my mortgage, and that's kind of it. And there's a lot more hidden costs, if you will, or costs that a lot of people don't think about that they need to be able to afford and to save for. So we'll get into that a little bit next week. But before we sign off, Nick, anything else that you want to leave listeners with?
No. thanks for having me, and listeners, thanks for listening to me talk about rates for 40 minutes.
Yeah, it was a big topic of discussion today. So just a whole smorgasbord of rate discussion. But I think it's prudent just given the environment that we're in. So thank you everybody for tuning in to episode 219 of the Independent Advisors Podcast. Hope you all have a wonderful rest of the week. And we will be back with you for episode 220 next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.